Now, there are various ways in which to invest, and there is not necessarily a single right way to do it. So it helps to understand the different approaches that you could take. One of the approaches is called factor investing. Let me get on my first guest. We've got Pratik Oswal, who is the head of passive business, fund business at Motilal Oswal AMC. Thank you so much, Pratik, as always, for taking the time. Let's start with the most basic question. What is factor investing? Where did it emerge? What is the history of this term? And how does it relate to investing in India?
Thanks, Alex, for having me on the show. When you look at the investing landscape, I think there is obviously a side of investing, called rules-based investing, which is basically investing on the basis of certain rules, predetermined rules. And within that, you have two different types of funds. One are called quant funds, and the other one is called factor funds. Quant funds are basically funds where you really don't know what the underlying rules are. That's the secret sauce of the asset management company. And the whole idea behind a quant fund is to outperform the benchmark. The other side of rules-based investing are called factor funds, which are very early days for factor funds. But we see a huge opportunity in this space for investors. For you to get more options into investing. For example, in the US, factor funds are about $3.5 trillion worth of investments, which is by I think comparison more than India's GDP. So pretty big way of investing. And factor funds, unlike quant funds, are funds where the rules are completely I would say transparent. So investors know basically what rules govern those funds. So let me give you an example. You have different factors, and factors are essentially styles of investing. I'm sure a lot of investors out there would have heard of momentum, would have heard of value, would have heard of quality, would have heard of low volatility or stability in terms of investing. And these are essentially I think factors. And an investor essentially can get access to these portfolios with follow these strategies through our factor fund. Factor funds have been around for I would say almost half a century. And obviously they're also coming to India in a very big way as well. But let me give you an example of what factors could mean to investors by taking advantage of an analogy. Suppose you wanted to buy a car today, and you are looking at certain qualitative metrics like the longevity or the fuel economy, all of that. So that would be qualitative metrics, and basically that's how you would filter out which car you would buy. A quality fund is very similar. You would essentially take the entire universe of stocks and basically add some quality filters like ROCE or long-term profitability, which would come to an underlying set of that you would invest in. So essentially, just like quality, you have momentum, for example, where you would want to buy stocks which have done really well in the past and like in the recent past, because history says that these stocks actually end up doing well over a long-term basis as well. So that's basically a momentum factor. You also have low volatility in value. Value is basically buying cheap. You would basically buy these stocks at very low prices in terms of price to book or price to earning. So basically these are all factors. And what the research says is that factors are in between active and passive funds. So they are built to outperform the underlying index, but are also are available for super low cost. So they're basically in between. And what we've seen from study in India in the last 15 years is that most of these factors that I talked about have actually outperformed the benchmark over, say, long time periods. And they're also now available at very low cost. So I think they sort of are enable investors today to maximize their wealth while also saving costs.
We've had conversations about a smart beta in the past, Pratik, and in things that I was reading ahead of this conversation, there are people who've used factor investing and smart beta interchangeably, but as I understand it, they're entirely different. How do you understand how they are different? And the reason I ask is because smart beta has its share of critics. People have said that they haven't seen smart beta work as well as it was slated to work.
Yeah. So that's actually true. I think if you, I would say, you have beta indices, which is your traditional Nifty 50, Sensex, and then you have smart beta, which is essentially a term coined for, coined by Wall Street to talk about funds that are smart in the sense that they would do better than beta funds. What we've seen in the US, at least in the last couple of decades, is that these funds are not as smart. So at least in the US, what we've seen is that, and now I think a lot of these funds are now called strategy indices as opposed to smart beta indices. So yes, I think it's important to realize that people should have expectations in place to say that these funds do not outperform in all market scenarios. Just like most or almost all actively managed funds out there, you will see bouts of underperformance and outperformance. So I think investors looking at these funds, should ideally have a long-term approach when it comes to these sort of strategy indices. But the idea behind these indices is to get investors give investors access to a certain strategy. We have fund managers who are value pickers, who are quality pickers, who are growth pickers. You can get access to that particular strategy in the form of a strategy indice or a factor fund.
So let's talk about factors a little bit more. My understanding would be that in different in different scenarios, you'd have each of these factors that would shine, right? So would the strategy therefore be to have a portion of your portfolio allocated to each of these factors? Is that the approach to have diversification within these factors as well?
Yeah, absolutely. So when you look at your investment portfolio, we usually talk about, and this is from a wealth manager perspective, a core portfolio and a satellite portfolio. Core portfolio is a portfolio which you'd never touch for a very long time, 10, 15, 20 years, as long as possible. And then you have a satellite portfolio where you'd want to take bets on, certain funds for 3 to 5 years time. So I think factor funds, fit in the satellite portion of portfolio. As you said, you're absolutely right. Certain factors work in certain market conditions. So to give you an example, in a bull market scenario, like what we've had in the last, say, 5, 6, maybe 10 years, momentum as a strategy ends up doing really well. And this is apparent from all sort of markets and asset classes. So if you are expecting a bull market, which, we sort of are, then momentum is a good strategy to go. Apart from momentum, also, if you look at other cycles, for example, a bear market cycle, what we've seen is actually quality does really well in a bear market cycle because, quality ends up, holding value in a much better way. Apart from quality, even something like low volatility also ends up doing well. So I think, yes, you can essentially, a lot of people in the US and in other parts of the world, have actually used factors to be able to play the different market conditions. Whether it be expansionary or whether markets are not doing well. So yes, for downside protection, for example, quality and low vol does super well for investors. Whereas the sort of market we are in today, momentum is the one factor that is doing very well. So yeah, so there is like a certain attribute to factors, and we believe that it really depends on the customer. What the customer is trying to get out of factors. It's fairly most of the interest that factor investing has comes from advisors as opposed to direct retail clients. So I think a lot of the advisory universe is extremely well. I mean, I think they're the ones who sort of utilize factor funds the most.
Okay. I want to talk about the nitty-gritties of it. Like, for example, if I were to talk about a quality factor based fund, how would it work? In that, where does the fund manager come in? How, at what stage? So I'm guessing because it's a factor, you're setting the rules right at the onset, right? And there are filters that are then put in place, and that would then determine the number of stocks that get selected. Could you take us through how this works?
So, unlike obviously, actively managed funds where you have a fund manager who's taking a call about which stock to buy, which stock to sell, factor funds are actually passive funds. So there is not really a fund manager, you essentially are trying to replicate an index, so for a lot of the factor funds that are out there, you are basically replicating a Nifty or a BSE sort of index that's, sort of capturing those factors. So there is not a really like a lot of any sort of involvement of a fund manager, which is good because you're completely, I think the bias is not there. You know that quality is subjective. I think different people have different versions of quality, but because in factor funds you don't have that subjectivity, the rules are pretty much fixed. So a lot of the quality, like a quality factor fund that you see, its calculation is predetermined. So you know exactly which stocks are there and why they are there. And this is basically based on global standards. So, like a quality fund in the US would be very similar in terms of a quality fund in India. So basically, a lot of these funds are based on predetermined rules which are set, and you know exactly what those rules are. So to give an example, say a Nifty 200 quality 30. It's basically the top 200 stocks in the Nifty, which is top 200 companies in India. And within that, you would basically use standardized filters like debt to equity, ROCE, and ROA, which are basically good measures of profitability and quality. And essentially, you would basically take the 200 stocks and choose the ones that have the best quality sort of characteristics, and you would invest in those 30 stocks which that. So what you've seen is that instead of you as a retail investor trying to do stock selection on your own, a quality sort of factor fund, like a quality index fund, will do that job for you in a very sort of rules based and a non-biased way. So you can ensure that there will be no sort of changes in strategy that you'll see in the fund. So that's basically how the quality fund is structured, and it goes the same for whether it is for low volatility or value. So for example, in a value fund, you would basically just have a bunch of stocks which are extremely low priced. So for example, value, for example, in 2021 did really well. So I think it really depends. So the rules really determine like the stocks that you end up investing in. And that's how sort of factor funds are different, because you get to invest in that in a very rules-based framework.
Okay. Where does the industry stand right now here in India in terms of regulatory approvals, in terms of products available right now?
Yeah. So so in terms of I think to my experience, I think where passive funds, or this is ETFs and index funds, were say 2 years back. So 2 years back, I used to do these sort of interviews, and I mean the way I talk about factor funds was how I used to talk about index funds and ETFs. So I think that's where I think the market is. There are a few products out there, but there's not a lot of education out there about what factor funds are. So I believe it's early days, for this, but we'll see a host of products coming in over the next year or so within this sort of domain of factor funds. I think you have obviously the broad-based funds which are doing really well, like a Nifty or a Sensex. But in India, I think people tend to be I think be a little bit more return chasing or yield chasing, which may or may not be a good thing. But I think factor funds have demonstrated the best of both worlds, where you have low cost and you also have historically high returns. So I think that's the sort of spot where these funds stand, and very early days, but obviously the next 3 to 5 years we'll see a lot more action happening in this space.
I want to ask a more broad-based question. We've spoken about factor funds, but as head of the passive business, you probably have a lot of insight into this. What is the kind of response that you're getting, that people have now? Is there more of an active participation? Is there more interest in that passive investing? Traditionally, Pratik, and conversations we've had in the past, is a great pitch for the core of your portfolio, and then you can build it like you build with building blocks, right? So have you managed to get that conversation out? What's your experience been?
Yeah, so I mean, this is on overall sort of the index fund ETF space, or just factors?
No, it's on everything. It's on passive investing as a whole.
Yeah. So I think overall, we've at least I think there has been a lot happening in this space. A lot of newer AMCs coming in, a lot of new products happening. I think last year there were a record number of fund launches in the passive index funds and ETF space. So I think overall, at least, I mean, MOMC, our strategy has been building blocks for asset allocation, we strongly believe that a lot of conversation on fund selection is going to sort of go into asset allocation over the next 5 years, and we want to obviously provide building blocks for that to all our advisors and all our customers. And so far the pickup has been great. I think in addition to obviously more funds in the space which have taken off in terms of assets, if you look at just monthly flows, there's a lot of flows coming in passive funds, and it's mostly retail. But I think now going forward, you're seeing a lot more flows from institutional and also HNIs. I think a big sort of lead in this industry is coming from a lot of these fintech platforms. So they have been extremely, been sort of the forefront of, I think educating, index funds, ETFs to investors. So I think they have been the lead over the last couple of years. And also, in addition to obviously these passive funds, those broad vanilla, what we've also seen is a huge explosion in asset classes. So for example, international investing was an asset class that didn't exist 2 years back, and now obviously it's become huge. You had debt index funds and ETFs. I think no one really thought debt would do well, but that has exploded. And also you had gold and silver. So I do think that I think asset allocation as a category has really become big. And when it comes to asset allocation, it's all about asset classes. So within the equity space, obviously people are going with, I think active and passive both are there. But within other asset classes, say international, gold, debt, that's where really passive has really taken off in a very big way. At least what have you seen in the last couple of years?
Well, it's been an absolute pleasure speaking with you. Thank you so much for taking the time.
Thanks, Alex, for having me out here. Thank you so much.